Hello everyone, and welcome to this session in which we will discuss bonds. What are bonds? Bonds are financial instrument, a piece of paper used by companies to raise capital, to raise money for project, expansion, operating the business without sacrificing ownership equity. Simply put, you borrow money rather than selling stocks. And bonds can be issued by for-private corporation, not for-profit corporation. They could be also issued by government. They're issued by government all the time. Now the question is, why raise money through bonds rather than loans? Well, this is what we will discuss in this session, some pros and cons for bonds. But bonds are offered to the general public. It allows anyone, you and I, can buy bonds. Therefore, the company can reach a wider buyers rather than just one or two banks. This provides access to larger pool of funding compared to traditional banks. Sometimes the interest rate on the bond might be lower. That could be another advantage. But anyhow, what we'll do in this session, tell you about advantages and disadvantages of issuing bonds, selling bonds to raise money, because that's one way to do what? To raise money. You can do it through debt, which is bonds, and loans or equity. In this series of recording, we'll talk about bonds, starting with advantages and disadvantages of selling bonds to the public. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. Let's discuss the advantages for selling bonds to finance your operation. There are three main advantages for issuing bonds to finance your operation. The first one is you are not affecting your equity. What does that mean? When you finance yourself, remember the accounting equation, which is what? Assets equal to liabilities plus equity. So when you finance yourself, you are using debt. You are increasing your debt to increase your equity. What does that mean? It means your equity is staying the same. It means the current owners, they don't affect the ownership structure. Therefore, equity holders, they would prefer to finance yourself with debt rather than stocks, because if you issue stocks, their ownership interest in the company gets diluted. So the more shares, the more common shares we have, the lower is your ownership level, unless you buy enough shares in proportion of your ownership. So if the company is issuing 1,000 new shares and you are currently a 10% owner, you have to buy 100 new shares or your ownership level gets diluted. So that's why bonds is preferable for the shareholders. That's one reason. Another reason, and that's an important reason, is interest on bonds is tax deductible. So what does it mean, tax deductible? It means when you pay your interest, it would lower your taxable income. And if you lower your taxable income, you would lower your taxes. It means you would lower your tax bill. It means you can save money if you issue bonds. Why? Because the interest that you pay is tax deductible. Okay? Compared to what? Compared to dividend. Remember, you have two options. You can issue stocks
So to finance yourself, you can do it through bonds, which is debt, or you can do it through equity. Bonds and liabilities are basically the same. If you choose bonds, and if you happen to pay $1,000 in interest, you reduced your taxable income by $1,000. What does that mean? It means if you take your $1,000 multiplied by 1 minus the tax rate, let's assume you're paying 30% in taxes, your net cost is $700. So you paid $1,000 and your net cost is $700. Net cost. Why? Because you saved $300 on your taxes. How do we compute the savings? You'll take what you pay times 1 minus the tax rate. So the interest on the bonds is tax deductible. That's another advantage. The third advantage, and this could be a disadvantage because this is a double-edged sword, bonds can enhance return on equity. We're going to see this through an example, but I want you to understand bond can also affect return on equity negatively. It could reduce rather than enhance. It can reduce your return on equity. By used borrowing funds, companies can potentially notice earn a higher return than interest they pay. This is the concept that's known as financial leverage, and in finance I have a whole recording about financial leverage, how financial leverage work. We're going to show it briefly, but I want you to understand financial leverage is a double-edged sword. The best way to illustrate financial leverage is to take a look at an example. Let's consider Sparkle. Currently has 2,000 in equity, or 2 million or 2 billion, it doesn't matter, and is planning to raise 1 additional million or 1 additional billion or $1,000. Sparkle predicts that this expansion, if they invested this additional 1,000, they will earn an additional $250. It currently earns $200 annually, and it has no interest expense. What does that mean? If we assume no interest expense, it means they have assets equal to debt of 0 plus equity. So right now, if equity is 2,000, this is what we're looking at. We're looking at a company with no debt. Just to illustrate the point. Now, the company will have 3 plans. They don't have to do anything, stay as is. Plan B is to expand and raise the $1,000 in equity. It means add $1,000 equity. Remember, we said assets equal to 0 plus equity because we have 0 debt. What we're saying is to raise that $1,000, issue equity, or raise $1,000 in bonds and pay 8% or $80. The other option is to issue that $1,000 but get that $1,000 from bonds. It means don't increase equity. Let's see what would happen under the various scenarios. Let's look at the first option. The first option, the company is earning $200. They have no debt. Net income is 200. Equity is 2,000. 200 divided by 2,000 equal to a 10% return on equity. Plan B, equity financing. You raise the $1,000 using equity. Now you add 250 to your net income. Now you have 450 in income before interest. You still have no interest because you raised money through equity. Net income equal to 4,000. Net income equal to 450. 450 divided by 3,000 of equity because now we have more equity. We raised an additional $1,000 in equity. Your return on equity is 15%. Let's assume you issued the bonds to finance yourself. Well, net income will be 450. You have interest expense of 80. Net income is 370. 450 minus the interest expense equal to 370. Your equity remain at 2,000. If you take 370 divided by 2,000, the return on equity for the shareholders went up. Why? Because the shareholders, although the company did not make as much money as before because they had to pay interest, nevertheless, as a shareholder, your return on your equity, on your current equity, went from 15 to 18. Why? Because you are using other people's money. Now, what's the risk? The risk is this. The risk is in plan C. The risk is this. You forget about this. The risk is this. The risk is you borrowed the money, but you could have only added $280. You could have only added $80 to your to your profit. Therefore, your profit is 280. You still have to pay 80. You're back to your original. So if it's 280, you're back to 200. So the point I'm trying to make is you have to earn more than $80 or 8% on your investment in order to increase your return on equity. Anything below, obviously, if you earn only $60, now your net income is 180, and now your return on equity went down. So financial leverage is a double-edged sword. As long as you can use it to enhance your return above your cost, perfectly fine. Otherwise, you are in trouble. Let's take a look at some disadvantages of bond, and hopefully you could have thought about some of the disadvantages. The first disadvantage is it could reduce return on equity, which is the opposite of enhancing your return on equity. And I just showed you that if you earn less than $80 on that borrowed funds, well, your return on equity will decrease. Now, bear in mind, this risk is higher for companies with low income or losses because it's going to increase your losses. And if you have a low net income, it might take you into a negative territory. Bonds require mandatory payments. That's another disadvantage of bonds, and we're going to talk about bonds more shortly. When you borrow money, you have to make payments at certain intervals. You have to. You must. You have to. That's the nature of debt. That's the nature of borrowing. You have to make regular interest payment. Also, you have to repay the loan, the par value at the maturity date when the bond mature, and we'll talk about that in the next few recording. This is a disadvantage because you always have to come up with this money on regular intervals. It could be semi-annually, it could be annually, and at some point you have to come up with a large sum at the end of the life of the asset. This could be a significant burden on cash flow constantly from year to year that you have to deal with. If you financed with equity, you don't have to make that payment. Why? Because you only pay dividend to the shareholders when you want to. When do you pay dividend? When the company makes a profit. Well, you cannot tell the lenders, just wait for me, let me make a profit, then I will pay you. They don't wait. Because the lenders, they're not interested to be part of your business. That's why they are lenders. They are not owners. The owners, they can wait. You don't have to pay yourself, but you have to pay your bank. What should you do now? You want to go to Farhat Lectures, look at multiple choice, true false exercises, additional resources. That's going to help you with your financial accounting course. Invest in yourself. Good luck, study hard, and of course, stay safe.